Hello friends, welcome in my YouTube channel Incredible Vindia. Today I am explaining about loan and their types. Now don't waste the time and start the video. And those who are new in my channel, please subscribe my channel Incredible Vindia and like the video and share the video. In finance, loan is the lending of money by one or more individual, organization or other entity to other individual, organization, etc. The recipient incur a debt and usually liable to pay interest on that debt until it is repaid, as well as to repay the principal amount borrowed. The document evident the debt will normally, especially among other things, the principal amount of money borrowed, the interest rate the lender is charging, and the date repayment. A loan entails the relocation of subject asset for a period of time between the lender and the borrower. The interest provided an incentive for the lender to increase in the loan. In a legal loan, each of these restrictions is enforced by contract, which are also place the borrower under additional restriction known as loan covenant. Although these articles focus on monetary loans, in practice any material object might be lent. Acting as a provider of loan is one of the main activities in financial institutions such as banks and credit card companies. For other institutions, issuing a debit contract such as bond is a typical source of funding. Secured. A secured loan is a form of debt in which borrower pledges some asset. A mortgage loan is a very common type of loan used by many individuals to purchase residential properties. The lender, usually a financial institute, is given security, a lien on the title of the property, until the mortgage is paid off in full. In case of home loan, if the borrower defaults on the loan, the bank would be legal rights to repossess the house and sell it to recover some owing to it. Similarly, a loan taken out by a car may be secured by the car. The duration of loan is much shorter, often corresponding to the useful life of car. There are two types of auto loans, direct and indirect. In direct auto loan, a bank lends to money directly to the customer. In a indirect auto loan, a car dealership acts as intermediate between the bank or financial institute and the customer. Other forms of secured loans include loan against securities such as share, mutual fund, bond, etc. This particularly instrument issued customer a line of credit based on the qualities of the securities pledged. Gold loans are issued to the customer after evaluating the quantity and quality of gold in item pledged. Corporate entities can also take out secured lending by pledging the company assets, including the company itself. The interest rates for secured loans are usually lower than those of unsecured loans. Usually, the lending institute employ people to evaluate the quality of pledge qualities before sanctioning the loan. Unsecured loans are monetary loans that are not secured against the borrower asset. These may be available for financial institutes under many different guidance and marketing packages. Credit card, personal loan, banking overdraft, corporate bond, peer-to-peer lending. The interest rate applicable to these different forms may be depending on lender and the borrower. These may or may not be regulated by law. In United Kingdom, when applied to individuals, these may come under the Consumer Credit Act 1974. Interest rates on unsecured loan are nearly always higher than the secured loan because an unsecured lender option from recourse against the borrower and the event of default are survival limited, subjecting the lender to higher risk compared to the encounter for a secured loan. An unsecured lender must, say the borrower, obtain a money judgment for breach of contract and the pulse execution for the judgment against the borrower uncompressed asset. In insolvency proceeding, secured lender traditional have property over unsecured lender when a court divide up the borrower asset. Higher interest rate reflect the additional risk that in the event of the debit is uncontrollable. Demand loan are short-term loan that typically do not fix date of repayment. Instead, demand loan carry a floating interest rate which vary according to the prime lending rate or other defined contract term. A demand loan can call for repayment by the lending institution at any time. Demand loan may be unsecured or secured. Loan can also be categorized according to whether a debitor is an individual person or business. Personal. Common personal loan included mortgage loan, car loan, home equity line of credit, credit card installment loan and payday loan. The credit score of borrower is major component in an underwriting and interest rate of these loans. The monthly payment of personal loan can be decreased by selecting longer payment terms, but overall interest paid increase as well. A personal loan can be obtained from bank, alternative lender, online loan provider and private lender. Commercial loan to business are similar to the above but also include commercial mortgage and corporate bond and government guarantees loan. Underwriting is not upon credit score but rather creating rating. The most typical loan payment type is the fully amortized payment in the each monthly rate has same value of over time. Most of the basic rules governing how loan are handling of tax purpose in United States are confirmed by both Congress and Department. Regulation another set rules interpret the Internal Revenue Code. A loan is not gross income the borrower. Since the loan have option to repay the loan, the borrower has no access to wealth. The lender may not be deducted the amount of loan. The rationalize here that one asset has been converted into different assets. Deductions are not typically available when an outlay serves to create a nerve or different asset. The amount paid to satisfy the loan obligation and not deductible by the borrower. Repayment of loan is not gross income to their lender. In effect, the promise to repay meant to convert it back to cash with no essence to wealth by the lender. Interest paid to the lender is included in a lender gross income. Interest paid represent. Thanks for watching my video. Those who are new in my YouTube channel, please subscribe my channel Untitled Chapter and press bell icon for new video notification. Thank you.